The Central Bank of Nigeria has revoked the operating licenses of ASO Savings and Loans PLC and Union Home Savings and Loans PLC, citing breaches of regulatory requirements under BOFI 2020 and mortgage banking guidelines. The Apex Bank said the lenders were undercapitalized, insolvent, and failed to meet minimum capital thresholds. We have joining us now to break this down and make it clearer to us, Ayokunle Olubumi, Head Financial Institutions Ratings, Augusta & Co. And we also have Anita Obiozama, Investment Research Analyst from Meristem Securities Limited. Good morning. All right, I'll begin with you, Ayokunle. What specific regulatory breaches would you say led to the CBN revoking the licenses of ASO Savings and Loans as well as Union Homes?
Sean, it borders largely about the capital base of the mortgage banks, and like we all know, for every bank, the capital is very important because it serves as a buffer for you to be able to expand operation and even support your business activities, because your losses will actually even come from capital. But having said that, for those of us that have been around in the market, you notice that over the last couple of years, both ASO Savings and Union Home, they've been having financial challenges. Even some depositors are even struggling to even access their funds from those institutions, right? So it's not surprising that we are seeing the CBN move in this way, right? Both companies are actually, they've been struggling for a couple of years.
Yeah, indeed. And I'm coming to you now, Anita. We know that there has been a lot of focus on the more larger traditional banks. But looking at what's happening now with this mortgage banks, does this action signal deeper stress within Nigeria's mortgage banking subsector? Does it need more attention?
This does not necessarily signal a deeper stress or any systemic crisis in the mortgage bank or in the banking sector generally. Rather, it does says to show that the CBN is currently reinforcing its efforts to strengthen the financial system by just basically weeding out these banks that are not able to withstand these economic shocks. And this action does shows that the regulators are willing to step in to protect depositors and also maintain the transparency and confidence in the financial service sector. And also, importantly, we also see that we've seen the CBN come in last year to talk about the recapitalization for the banking sector, and now this helps to align with the broader this particular movement from the CBN, and it helps to we also see the insurance sector also being recapitalized currently. I mean, it just shows to one direction where the CBN is trying to make sure the financial service is well stable and strong enough to weather any shocks coming to them.
Mm-hmm. And we know that NDIC has said that they will be returning, I think, about 2 million in terms. If you can let us into how they're going to manage the situation and protect depositors in, this scenario. Can you let us into that briefly and how effective this strategy is?
The NDIC insurance cap, the cap of 2 million naira, right? This kind of provides real protection for depositors, especially the small depositors where they have little money in the bank, and this kind of provide confidence for their money. I mean, if I'm a small scale business and I'm keeping my money and the NDIC has a cap of 2 million, I'm very sure that if anything goes wrong, I'm going to get my money back. But now when you look at this from the last scale of the large scale depositors, I mean, it's a worry for them because some of these businesses have more than this cap in the account, but there are rules set for them. I mean, for this particular ASO Savings and Union Homes, the NDIT has said that they are going to deposit 2 million to customers who have who have below this amount, but for the other depositors who have above this threshold, they will try and recover these assets as fast as possible, and also pay and pay it as a liquidation dividend also.
I mean, interesting developments. Now I'm coming back to you, Ayo. So she has hinted on, what happens in this situation, the modalities. What is your perspective on this, especially in a high inflationary environment, depositors with balances above the insured threshold, and how long could liquidation payouts also realistically take place?
Like Anita mentioned, there has been some concern about just 2 million. That's what NDIC is paying out. But let's also not forget that NDIC is working with data, and according to NDIC, about 80% of bank accounts, right, are below the threshold that they're actually covering. So that means that if 80% of bank accounts have balances below 2 million for mortgage amounts, so a lot of them will actually even be paid out. Then, as regards the other depositors, those with significant deposits higher than the 2 million, definitely is what is as fast as they can actually even recover the assets, right? They need to pay, they need to dispose the assets, sell it off, and now they are getting those proceeds, right? It will be distributed as liquidation dividends for those depositors. And we've seen something similar happen to Heritage Bank depositors. I think about 10% was actually even paid out, right, a few months ago, and in addition to the 5 million that was paid to the initial payments to depositors of Heritage Bank.
So this could stretch out for a while. Let's look at, we have basically 2 failed banks, and within the mortgage banking space, do you see this revocation perhaps triggering a loss of confidence in other primary mortgage banks, Ayo?
If we have something like that, I don't think, although in the short term, there might be some concern, but I don't think the impact is going to be that much. Why do I say so? Like I mentioned earlier, we all know that these institutions are challenged. And I'll be surprised, a lot of depositors have actually even moved their funds out, right? So it's not that a seemingly good, well-run mortgage bank is collapsing. But these are institutions that we all know for years that they've been having protracted issues. Let's not forget that the REITs that Union Home started was actually even was taken away from Union Home and given to an investment firm to actually even manage on their behalf, just to protect the investors at the REIT. So it's actually what everybody's seen coming. But having said that, what this also done is to also spotlight the challenges that we have in the mortgage sector, right? Because of the mortgage industry, because the mortgage industry seems to be one of the most challenged industry in the financial services sector, from the asset liability mismatch, access to funding, the challenges in recovering assets, the high level of NPLs, right? There seems to be a lot of challenges in that particular sector. Notwithstanding some improvements in funding, for instance, we've seen MREV, we've seen family homes, we've seen NMRC, we've seen a lot of financial initiatives to help to provide liquidity support to that particular industry. But there's still a lot of challenges within that particular space.
And as you have said, a lot of people, or a number of people, saw this coming from afar. They've had issues going on for quite some time. So I'm coming to you, Anita. There are some who say that this measure is reactive, not preventative. So how robust is the CBN's current supervisory framework when it comes to detecting distress early enough to prevent bank failure?
The CBN supervisory framework is quite proactive, as we've seen. The CBN has made it known that, as we've seen, first of all, the banking sector itself is the financial backbone of the economy. And CBN has found a way to make sure that this backbone is well situated on foundation. And we could see it in the way that they've been able to make sure they regulate this the financial service. And when we look at the capital adequacy ratio, we look at if this bank is able to absorb enough capital to be able to absorb enough loss, rather. Look at the asset quality and to check for levels of the non-performing loans. I mean, due to the fact that we've had unstable macroeconomic conditions over the years. I mean, last year, from saying that we've seen inflation go up as high as 30. I mean, it's affected so many sectors. It affected, individuals, businesses, and it was not able for them to pay back their loans that they collected from these banks. And this affected banks and it increased their non-performing loans. And this is why the CBN has come in place. And we also brought, for the commercial banks, they brought the single obligor limit, and so to be able to control the banks, to be able to not to give out too much loan when they cannot recover this loan. I mean, these are the frameworks the CBN has put in place to be able to protect the financial service sector in general. And when it comes to the case of ASO savings, their financials have not really been so great. Coming from years back, we've seen that they've been in the negative equity position for years, and we've seen that their assets were not able to cover their liabilities at all. And I mean, in banks, the liability is what we turn into our assets to be able to make money back. And if you're not able to turn these assets and this liability to make money for the bank, I don't know what they are actually doing. So, I mean, this is good as the framework set by CBN is very good. So that way it helps to weed out whatever financial institutions that's not able to meet up these requirements.
And I'd like to get your thoughts on that. She's saying, CBN has a strong enough framework to address these issues. Do you agree?
Yeah, we agree with that to an extent. And because what we've seen is that CBN tends to focus more on the commercial banks relative to the other non-bank financial institutions. And it's not the CBN's fault. Because if you look at the number of institutions, right, that in the non-bank financial space, the mortgage banks, the microfinance, the finance houses, they are actually a lot, right? So it's actually been a challenge trying to regulate that particular and supervise those particular area effectively, right? And the focus have actually been more on the commercial banks, which rightly so, given the size and the strategic importance of the commercial banks in the economy. But I think a lot of attention might also need to probably be put into that. I think there needs to be a change in strategy in managing those non-bank financial institutions, because the volume is there are actually lots of them. They run into thousands, and getting the personnel to effectively look at those financial institutions, right? Something that CBN needs to actually look at, strategize in that particular area. Some of them, it takes a long while to get their financials approved because there are actually a lot of them, and getting CBN to approve them takes a bit of a while.
So they definitely have their work cut out for them. And I'm staying with you, Ayo, now. Let's come to the takeaways and the lesson, from this whole situation, especially for investors. What lessons should investors and even depositors take from this development when assessing financial institutions?
Okay, like I always joke with people, right? Look, for depositors, NDIC have told you that, look, the minimum threshold that you should have in each bank, they've given you what that threshold should actually be like. So, for instance, for a mortgage bank, anything above 2 million, you know that, look, you are taking a bit of risk on that. So that one also means that investors need to also needs to focus and scrutinize the financial performance of financial institutions where they have funds with. So a lot of depositors don't bother about even checking the audited financial statements. Do they have a credit rating? How is it creditworthy? Except for all the big the institutional depositors. A lot of depositors don't actually even do that. Then I think also another big lesson that we could see here is that, look, because if you cast our mind back before some years ago, ASO savings was doing relatively well. right? Some will argue that the genesis of their crisis started when they actually tried to acquire union homes. So I think we also need to acquisition needs to actually even be looked at thoroughly. Because if you look at the banking industry, the banking segment, the commercial banks, you notice that there are few banks that, without mentioning it, that the genesis of their crisis, or should I say that the crisis were exacerbated by the acquisition that they've actually even done. So investor needs to also scrutinize and ensure that, look, whenever they are doing an acquisition, you are sure of what you're actually even getting yourself into.
Indeed, extra attention in that regard. Coming to you, Anita, do you see this liquidation, the liquidation of these banks, do you see affecting mortgage availability and housing finance in Nigeria in any way?
When it comes to this, I don't think I see any significant change when it comes to the mortgage bank in Nigeria. I mean, it just goes to even show that there is regulations around this particular sector or subsector, to say, and also, like Ayo has said earlier, this particular market has also seen some support mechanism like the MREF, the Family Home Fund, and this are going to help to address this housing deficit and also improve access to this mortgage financing. In fact, this liquidation of these banks even is going to help to strengthen this particular subsector. That way, investors, depositors know who are the real players in this particular subsectors and go for them. I mean, that's what I feel it is.
And I mean, we've seen a review of minimal capital requirements with the larger traditional banks. We've seen that happen in the insurance sector. Would you say that mortgage banks are due for a review or upward adjustment when it comes to capital adequacy requirements?
A review for now for the mortgage bank, I think it's not necessary for now. But I feel like it could be considered in the future, quite all right. But I mean, the particular the particular field they're playing right now, it's okay for them because I mean they need to even stand their ground to be able to have this review and I mean, for the capital adequacy ratio is just 10%. When it comes to commercial banks, it's 15%. I mean, that's fair enough for the mortgage bank. And given that they are a long-term investment, I mean, that is actually very okay for them. Yeah.
And Ayo, do you agree? Should we push that forward some more?
Look at the mortgage industry. There are a lot of challenges. And don't forget that there was already an exposure draft for an upward review of the capital base for the mortgage bank since 2019 that is yet to actually even be pushed out because the industry is not making so much profit. They are struggling significantly. So there was the justification for investors to bring in more funds, right? Because their model has been because mortgages in Nigeria is very challenging given our high inflation. Given our high inflation, you notice that it's difficult for people to take on mortgages. And currently now we have less than 1,000 mortgages in Nigeria, in the whole country. Less than 1,000 mortgages. So if people are not taking up mortgages, even those that are taking up mortgages, the inflation rate is actually even raising the level of default. So while in that industry that is struggling, it's difficult for you to tell investors to actually even bring in more money. So I believe that there are a lot of things that needs to be done. A lot of things are actually happening in that particular space. It would be good to actually even get them up to a particular point. Once the business model seems to be able to justify adequate return, then you can tell investors to bring in more capital.
Okay. So a lot more needs to be done before we get to that point. And Anita, could we see more license revocations from the CBN to tighten compliance across the financial system?
Yeah, so yes, that is possible. That is very well possible because since we are still the process is still ongoing. I mean, the aim of CBN is to make sure the financial service is standing on a good foundation, and that is good for the economy at large. So yes, if any bank is not able to meet the required regulation, like come next year, March 2026, if any bank is not able to meet the minimum capital, I mean, that is a way. That just shows that the license is they know what this license. So at the end of the day, because at the end of the day, it boils down to we the depositors, how confident are we in the financial space, and this doesn't mean anything like a widespread failure. No, rather it's more of a continued cleanup of these weak financial institutions, and the goal is to actually strengthen the financial system and also ensure that there is resilience and compliance in the institution space.
All right, thank you so much. Very insightful conversation here, and we'll continue to track what happens within the sector. Ayokunle Olubumi, Head Financial Institutions Ratings, August & Co., and Anita Obiozoma, Investment Research Analyst at Maritime Securities. Thank you for your time.
Thank you.
My pleasure.